Ever wondered how your money magically appears when you use your ATM card? Or where it goes when you swipe your credit card? It's not sorcery or some intricate illusion, but the workings of a system that's deeply woven into our daily lives. Yes, we're talking about the banking system, a complex yet fascinating mechanism that keeps our financial world spinning. Every transaction you make, every deposit or withdrawal, is part of a vast, intricate dance. It's a dance choreographed by banks and financial institutions, set to the rhythm of interest rates, lending, and investment. But how does it all work? What's the secret behind this financial ballet? Well, it's no secret at all. It's a process that's both intricate and straightforward, a process that we'll be exploring today. So, buckle up, because we're about to embark on a journey into the heart of the financial world. Today, we unravel the mystery of banks and how they operate. Prepare to step into the world of banking. Imagine your money embarking on a journey every time you perform a banking transaction. Intriguing, isn't it? Picture this. You've just been paid. Your employer transfers your salary into your bank account, marking the start of your money's adventure. Your salary, now digital, is not physically stashed in a vault within your bank. Instead, it becomes a part of the bank's vast pool of funds. This pool, my friends, is where the real magic happens. Here, your money mingles with that of other customers. But don't worry, your bank keeps a careful tally of exactly how much belongs to you. Now let's say you decide to pay your rent. You click send on your online banking app. In a matter of seconds, the money leaves your account and arrives in your landlord's. But what really happens behind the scenes? The truth is, your money never physically moves. Instead, your bank communicates with your landlord's bank. They adjust their respective ledgers, decreasing your balance and increasing your landlord's. This communication is often facilitated by a central bank or other financial institution, ensuring the transaction is swift, secure, and accurate. But what about cash withdrawals, you ask? Well, when you withdraw cash from an ATM, your bank reduces your digital balance. The cash you receive is merely a physical representation of the digital money deducted from your account. Even then, your money is still part of the banking system, just in a different form. And there you have it, the journey of your money. It's not a physical trip, but a series of digital adjustments made by your bank, other banks, and sometimes the central bank. It's a complex dance of numbers and communications, all happening behind the scenes of that simple send button. So that's the journey your money takes. But how do banks keep track of all these transactions? Banks are like meticulous accountants, keeping a record of every penny that comes in and goes out. Picture this. Your bank is a giant, intricate ledger, a comprehensive record of financial transactions. Every time you swipe your card, deposit a check, or withdraw cash, this ledger is updated. It's like a diary that your bank keeps, recording the story of your money's journey. At the heart of this operation is a system called double-entry bookkeeping. It's been around for centuries, and it's the secret sauce that keeps the banking world turning. For every transaction, there's a debit and a credit. When you deposit money, your account is credited and the bank's cash account is debited. When you withdraw, the reverse happens. Now, let's say you want to know how much money you have. Enter the bank statement, a snapshot of your financial activities. It's a summary of the ledger's entries specifically related to your account. Think of it as a chapter in the book of your financial life, detailing the ebb and flow of your funds. But it's not just about keeping track of your money. This ledger is also a crucial tool for the bank's own accounting. It helps banks determine their assets and liabilities, calculate their capital, and assess their financial health. It's like a health checkup, but for the bank's finances. And what about those mysterious bank charges that sometimes appear on your statement? Well, they're also part of the ledger. Whether it's a service fee, an overdraft charge, or interest on your loan, it's all meticulously recorded. So the next time you glance at your bank statement, remember, you're looking at a tiny piece of a vast financial jigsaw puzzle. It's a testament to the intricate ballet of banking, where every penny has its place and every transaction tells a story. Now that we know how banks track transactions, let's delve into how they make money. Banks are not charities, they're businesses. But how do they profit from our money? Well, the answer is simpler than you might think, and it all comes down to two main avenues of income: interest on loans and fees for services. Let's take a closer look. Imagine you're a bank. People deposit money into their accounts, and you, as the bank, now have a pool of funds at your disposal. Rather than letting it sit idle, you make this money work for you. How? by lending it out to others who need it, such as homeowners, businesses, and students. In return for this service, you charge these borrowers interest, which is essentially a rental fee for the use of your money. This interest is a significant source of income for banks. But that's not all. Banks also make money through fees for various services. These can range from account maintenance fees and ATM fees to penalties for insufficient funds or late payments. While these fees might seem small to us individually, when multiplied by the millions of customers a bank serves, they add up to a substantial amount. Now, here's where things get a bit more complex. Banks operate on what's known as a fractional reserve system. This means that they're only required to keep a fraction of deposits on hand, while the rest can be loaned out. This system allows banks to create money out of thin air, which is a concept that may seem peculiar, but is indeed the reality of our financial system. So, to sum up, banks make money by charging interest on loans and fees for services, and they're able to lend more money than they physically have due to the fractional reserve system. It's a finely tuned machine that keeps our economy running. Banks indeed have an interesting way of making money, but what happens when things go wrong? Stay tuned as we delve into the intriguing world of banking crises in our next scene. Banks are robust institutions, but even they can fail. What happens then? Picture this. You've been diligently saving, depositing your hard-earned money into a bank you trust. But then the unthinkable happens. Your bank fails. What happens to your money? Where does it go? When a bank fails, it's unable to meet its obligations to its depositors or creditors because it has become insolvent. This means the bank's liabilities exceed its assets, and it can't pay back the people who've deposited their money. Sounds scary, right? But don't panic just yet. In many countries, including the United States, there are safety nets in place to protect depositors in the event of a bank failure. This is where the concept of deposit insurance comes into play. Deposit insurance is a measure implemented by several countries to protect bank depositors, in full or in part, from losses caused by a bank's inability to pay its debts when due. In the US, for example, the Federal Deposit Insurance Corporation, or FDIC, insures deposits up to $250,000 per depositor per insured bank. So if your bank fails, the FDIC steps in to protect your money up to that limit. But what about those banks that are considered too big to fail? These are banks so large and interconnected that their failure could cause a catastrophic effect on the economy. The concept of too big to fail implies that the government will step in to rescue these banks should they falter to prevent economic disaster. However, this concept has its critics. Some argue that it encourages reckless behavior by banks, knowing they'll be saved if things go wrong. Others believe it creates an uneven playing field, favoring large banks over smaller ones. So while bank failures can be alarming, there are mechanisms in place to protect your deposits. It's important to understand these protections and ensure your money is in insured accounts. So that's how the system works to protect our money, even in the face of a bank failure. Banks are more than just buildings with vaults. They are intricate systems that keep our economy running. Imagine a network of channels where your money flows from your pocket, through the bank, and into the wider economy. Each transaction, a ripple effect, causing a myriad of other transactions. But it's not just about the flow of money. Banks also serve as guardians of our funds, responsible for maintaining the trust we place in them. They use sophisticated systems to track every penny, ensuring that our deposits are secure and accessible when we need them. Plus, banks are the architects of profit. Through lending and investing, they generate returns, fueling growth and prosperity. But remember, even these mighty institutions can stumble. When they do, systems are in place to safeguard depositors and restore stability. And there you have it, a basic explanation world of banking. Next time you make a transaction, remember the journey your money takes. Don't forget to show love by hitting the subscribe and like button, and see you in the next video.